need to make sure that, so it might be that I'm selling you insurance, and you think I'm the nicest person on the planet, and I might be the nicest person on the planet. But I don't understand, if I don't understand the product I'm selling you, it may not matter. I need to be competent. If I'm selling you a certificate or a derivative, etc., and I'm saying some stuff to you, and you trust me, you take me on your word, and I'm nice, I'm not trying to cheat you. But if I don't understand it, if I'm not competent, if I'm not qualified to understand it, it would erode confidence in the system. And that's what happened with Lehman Brothers. It wasn't that people were thought to be cheating or doing fraudulent practices like Enron in terms of accounting, etc. It's just that it eroded everybody's confidence in the competence of people working in the financial sector. Even when people earning $10 million, $20 million do not understand what they're doing, then how is the rest of the world expected to understand? How are regulators expected to understand? So that was the erosion in the confidence and competence. And the second, with the Bernie Madoff scandal and the other scandals, etc., which was straight cheating, that was the erosion of confidence in trust and well-meaningness. Is this person trying to cheat me? And it was the combination of both of these, the erosion of confidence in competence and the erosion of confidence in trust, that led to the scale of the financial crisis. And again, you as the frontline workers, as the people who are insiders in the financial industry are right at the heart of making sure that this doesn't happen again. I have some ideas for how we could look at the financial system needing to get restructured, and let me present them to you. One is a principle of competitiveness. We need to make sure that the financial system we've come up with at the end of the crisis is more competitive. What we had was a 20 to 25% return on equity for big investment banks, for some smaller niche outfits, for hedge funds, etc. 2 by 20 hedge fund fee structures, banks earning 30% on credit cards, charging massively for late payments, etc. And there was more than $100 billion of bonus payment just in New York and London. This was in 2006. So what you had was a large amount of rents being taken out, extracted from the financial sector. And I think there is a problem when the financial sector reports 30 to 40% of the total profit of the whole corporate sector. Because in the end, the financial sector exists to enable real business. You cannot touch finance, you cannot eat finance, you cannot drink finance. If you remember the story of King Midas, who touched anything and that became gold, he starved to death. He had the gift of money, but he couldn't eat it, he couldn't sleep on it, he couldn't touch it, he couldn't drink it. And I think it's an important lesson to remember that finance is an enabler. Finance is a sector that allows real economic activity to happen, which allows us to have more welfare, which allows us to make more food, drive fancy cars, have better refrigerators, but we cannot eat money, we cannot drink money. And what we've had is an evidence of a financial sector that has been consolidating more and more, larger and larger institutions, squeezing out competition. It didn't help that the current regulation we have in place, for example, the Basel II Accord on capital adequacy, etc., favored big banks over small, international financial institutions over domestic ones, and complex financial institutions which have subsidiaries in tax havens, etc., are able to have regulatory arbitrage over simpler ones. And this asymmetry, which meant there were economies of scale that already big institutions enjoy, combined with the public subsidy that they get, because Lehman Brothers was allowed to fail, but Goldman Sachs wasn't. Citicorp would have never been allowed to fail. It's just too big to fail. Similarly, if you look at the Norwegian landscape, Norges Bank, etc., Danske Bank, there's almost no way in hell that the government could have let them fail, and they know that. And that gives a public subsidy, which the smaller institutions, which can fail, which are allowed to fail, do not enjoy. So there's a doubling of disadvantage. And add to that the fact that the regulation was designed in a way that the larger institutions needed to have smaller capital, were able to choose their own risk management methods, etc., meant that smaller institutions, more niche institutions, which were actually serving real customer needs, got squeezed out, and more profits went to the bigger institutions. The high rewards available to employees, to big bankers and CEOs, etc., as we saw, combined with low competition, meant that there was a very strong incentive to take more and more risks. and the rewards were taken out. All these bonuses were spent already, but we are paying the cost. The taxpayer is eventually responsible. So barriers of entry to the financial system need to be lowered. Big, large institutions which are too big to fail need to be broken up, so their failure no longer poses a threat to the system. And this would not only deliver a better deal to customers. Customers often complain, I pay 35% on my credit cards in London now, which is ridiculous. But this would mean that customers get better service, there's more competition, and if you're not serving the customer's real needs, then you go out of business. And you're allowed to. And it would mean that the system would be less liable to crash, and that taxpayers would not be liable for massive amounts of subsidy, which they have been providing now and in the past in financial crisis. The second principle to remember is diversity. You must know when soldiers are crossing the bridge, they're asked to break step, because if they all march together, the bridge starts swaying and it collapses. And that's kind of the financial system we ended up with, where insurance companies behave like investment banks, hedge funds behave like commercial banks banks behave like hedge funds, and everybody was trying to do the same thing. Everybody was doing the carry trade, everybody was trying to sell complex products, everybody was invested in mortgage securities, etc. And the legal form of the institution didn't matter anymore, because you always found a way of circumventing regulation, and that meant that financial stability, which actually comes from a diversity of opinion. So if you're trying to do a business, if you're trying to set a market and you buy and sell, the only way a transaction will take place is, if I'm trying to sell you this computer, is that if you have attached a different value to the computer than what I do, and that means that you have a different view. It could come because you have a different investment horizon, it could come because you have different risk needs, it could come because you know something that I don't, it could come for several reasons. But it's diversity which promotes stability, because that means there's always a liquid market. But if everybody is doing the same thing at the same time, is using the same risk management systems, is exposed to the same kind of pressures to perform and 20-25% return on equity that the shareholders are demanding, then you all end up doing the same things, which means the system goes up together, but it also goes down together. And that's the problem we had. So we need to make sure that the whole range of financial institutions that we've had historically, for a good reason, savings banks, insurance firms, merchant banks, pension funds, hedge funds, development banks, etc., that they do what they're supposed to be doing. They need to have the competence to be able to do that, and they should not be able to arbitrage the regulation, for example, through using tax haven subsidiaries or off-balance sheet vehicles, etc. And when banks behave like hedge funds and hedge funds behave like banks, we run into trouble. So we need to make sure that doesn't happen again. There is another contradiction, which is in the risk management part of financial institutions. There has been this growing perception that we've become more sophisticated. We have a lot of IT tools, we are able to track asset prices, we know second to second how the Oslo Stock Exchange moves, we know what's happening to bond prices in Brazil, etc. There's a lot of information here. And we have a lot of computers, supercomputers sometimes in some banks, which are dedicated to using this information, including for risk management. But there's a fundamental contradiction, which is the idea behind regulation is that regulation is supposed to guard against market failure. But if you look at the risk management systems we have, value at risk, credit ratings, etc., these are all based on market prices. These are some forms of market prices. So the fundamental contradiction is that we are using market prices in our risk management to guard against market failure. And this doesn't work. It looks very sophisticated, it looks nice on paper, it generates a lot of jobs, but the fundamental point is that market failure cannot be tackled by using market prices. It has to come from outside. So we need more rough, coarse rule of thumbs, going back to the old-fashioned way. Limits on leverage, for example, making sure there's a minimum capital adequacy which is higher than what we've had. Making sure that the kind of just-in-time finance we've had, where everything's trading faster and faster, and you're sweeping liquidity into the central bank and taking it out, and the minute any link in the conveyor belt breaks in, the whole system starts piling up. It's like a traffic jam. If there's one accident, the kind of system we've had is just-in-time finance, where one accident will mean that there's a massive pile-up of cars crashing onto the first one. We need to make sure there are more speed bumps, that the system is slower, because that will make it more stable. The next point we need to think about is simplicity. The financial, there are those who say, especially on the left, that there is too little regulation of finance. But that's not true. There are thousands and thousands of pages of financial regulation. I don't know if any of you work in compliance, but compliance is a big job in the financial sector. If you look at the EU Capital Adequacy Directive, if you look at the MiFID, etc., if you look at all there's hundreds of thousands of pages of financial regulation. There's already more than 1,000 pages in the Basel Accord on capital adequacy. So, but the problem is that many of these miss the big picture. Many of these regulations are designed in a reactive way. And if you look at, again, what the process of designing financial sector regulation is, the big financial institutions actually play a big part in designing this regulation. And this is an interesting point which is not often thought of, but the more complex the regulation, the more the competitive landscape favors big institutions, because they can afford those costs of regulation. So when someone says that HSBC pays $800 million of compliance cost every year, the question to ask is not, oh, that's a lot of, but who else can afford to pay that money? So there is a very high level of threshold which creates barriers to entry, which creates barrier to understanding. And because we use prescriptive rules-based regulation, these are easy to circumvent because you just tweak this a little bit and then the regulator will catch up and do this. So we need to go back to more principles-based, rough regulation, which is simpler, which is easier to understand, which creates lower barriers to entry, but which is also less hard to circumvent. So rather than saying that you cannot invest in credit default swaps out of tax haven jurisdictions in the Asia-Pacific region, you come up with a more broad, general, more restrictive rule, but unless otherwise specified or something, you cannot invest in derivative instruments, something like that. So the point is to go back to more coarse, simpler regulation, because that's important. The second important thing to remember is products. Now, as a financial institution, I have a very strong incentive to sell you complex products. And the reason is threefold. One, the more complex the product, the more the information asymmetry between me, who is selling you the product, who knows and understands it, and the customer who doesn't understand it. That means I can get a higher margin of profit. The second is, in financial products, there is no patent system. So if today, if Nordea designs a new financial product, tomorrow Danske Bank will start selling the same product. And so the more complex you make it, the harder it is to copy, and that creates a competitive advantage. And the third and the most important reason is, the more complex the product, the more the information asymmetry between me and the regulator. That means it's easier for me to try and circumvent the regulation using complexity. And for all these reasons, the financial system that we have going forward needs to have a bias towards simplicity, with the basic principle that if something can be done in a simpler way, complexity is not allowed. It should be biased against complexity, because if it's not, products will become more and more complex, because it's in the interest of the financial industry to have so. It's not in the interest of people outside it, because more complexity means less transparency, which means if there is a disturbance in the system, people lose confidence quicker and it collapses. So this simplicity of products is important. The third is simplicity of financial institutions. You had a situation now where Citicorp has 2,400 subsidiaries. Lehman Brothers had 330 subsidiaries. I don't know how many Nordea has and Danske Bank have, but probably, maybe more than 100. And there's a reason behind that. That these subsidiaries were often used, sometimes with tax havens, sometimes with special purpose vehicles, etc., to arbitrage regulation. And the second problem it creates is, as you know, these financial institutions are international in life, but national in debt. It makes failing these institutions, it makes declaring bankruptcy or restructuring these institutions, as people are finding out with Lehman Brothers in London, very, very, very difficult. Because who do you have the liabilities? When I was trading derivatives, I was sitting in London and in the United States, and I was sometimes booking the trades from a Bermuda subsidiary, sometimes I was booking the trades from a Cayman Island subsidiary, sometimes it just creates massive amount of complexity and counterparty risk, etc. So one forward step is to make sure that the financial institutions that we have are simpler going forward, because otherwise the system is very subject to collapse, and also complexity creates the opportunities not just for higher profit margins, but at the cost of customers and at the cost of stability, but also greater opportunities for fraud, as we saw with Bernie Madoff. Last point I wanted to make in terms of the principles going forward would be to make sure that there is fairness in the system. As we saw, 100 billion bonuses were taken out, but that's not enough. If you look at financial institutions, including in Scandinavia, they pay amongst the lowest effective rate of tax compared to institutions that produce companies that produce cars, refrigerators, etc. Financial institutions are really, really good at reducing their own tax burdens. They're really good at paying their employees bonuses in the form of vintage wine bottles or shares in offshore companies, so the employees don't pay enough tax either. They are also extremely efficient at helping many of their customers, individuals as well as corporations, avoid tax burdens. Perhaps institutions like UBS, by enabling accounts in tax havens, as we found out recently in the case of the United States, or as we saw in the case of LGT, which is an institution in Liechtenstein, where German citizens are putting their money. But also, the highest paid guy in the City of London for several years was the head of tax structured products at Barclays, whose main job was to design tax avoidance strategies for big corporate clients. And he earned more than $100 million. And if he earned more than $100 million, his group must have earned a much more amount of money, which means, let's say his group earned $2 billion, which must have meant that he must have helped clients avoid $10–15 billion of money. I'm just speculating. But that's just the scale of one bank. So we have a system where financial institutions, especially large ones, do not only pay their own fair share burden of taxes, but help other rich corporations and individuals avoid theirs. But at the time the shit hits the fan, they are the first in line to ask taxpayers for funds for bailout. And what we have seen is the shocking example of banks such as Goldman Sachs, etc., going back to business as usual in terms of bonuses and compensation. It's almost like nothing happened. So let me finish by talking about briefly how to go forward. So what we've done up to now is we briefly talked about how we got here, our role as people working in the front line of the financial sector in getting here, the special role of finance, why it's central to the economy and why trust is such an important ingredient, and some of the changes, the principles of systemic changes that we need to have going forward. But because of the stance of the stake you have in the system, again, because your jobs are linked to the success of the financial sector, your reputation is linked to the success of the financial sector, and because the prosperity of the society is linked to the success of the financial sector, and you are the insiders. So it's the responsibility, the burden of responsibility is on you to make sure we don't go back to business as usual, that the financial sector we end up with is a different one, which is more stable, which is fairer, which is simpler, and which is more competitive and diverse. No matter what reforms happen, there are a lot of reforms being discussed, but the lobbying budgets that have grown 600%, combined with the fast going back to business as usual, means that many of those good intentions may not see the light of day. But whether that happens or not, so your first responsibility is make sure that it does, that these principles are incorporated in regulation, that we have a different system. But even if that doesn't happen, you still need to make sure, as the union, that there's increased whistleblower protection, that there is an ability to resist pressures to have performances linked to how many products you push through. that if you are pressured to push a product that you yourself don't understand or you do not think is in the customer's best need, there should be a redressal mechanism through the union of making sure that doesn't happen. And it's not just because of your own personal role in it, but also for the system as a whole, for society as a whole. It's your responsibility to do that. And most importantly, you need to make sure you can look your mother in the eye if there's another collapse. Thank you very much for having me.